Welcome. In this video, we're going to discuss cost volume profit analysis. But before we get started in doing that, I need to point out a couple things. Number one, we need to view this within the larger context of decision making. In other words, our cost volume profit model is a useful model for helping us in a decision making scenario. Secondly, our cost volume profit model is precisely that. It is a model. We need to realize that the cost volume profit model that we'll be looking at, which entails describing a total revenue function and a total cost function and how they interact, so forth and so on. We need to be aware that this is a special case of a more general scenario. It's a special case in the sense that we are assuming that we have a single revenue driver, which is sales volume. We are assuming that we have a single cost driver, which is production volume. And also we're looking at this in a short-term perspective. And that's important because in that short-range perspective, our fixed costs are not going to change. Now, I said this is a special instance of a larger general scenario whereby we have many revenue drivers. We'll look at this when we look at our balance scorecard. As we've seen in our discussion of activity-based costing, we're aware that there are multiple potential cost drivers, and likewise there are multiple different time frames for decision-making. Now, before we look at the specific assumptions underlying this model, I want to make another very important point about models. The cost volume profit model is a simple model. That in and of itself is not a problem. It's simple because we make assumptions, and that again is not a problem. However, what we need to do anytime we're trying to model something is we need to make sure that we assess how robust our model is. By robustness, I mean how well will our model still operate, still predict, or describe, depending on what our model is attempting to do, when the underlying assumptions are violated. It doesn't do any good to have a model that is not robust in the sense that if you violate any of its underlying assumptions, then it gives you nonsensical output. So what are these underlying assumptions? Well, the first and the most important is that we're assuming linear relationships. What is the implication of that? Well, the implication of assuming linear relationships is that our sales price is going to be constant and our variable cost per unit is going to be constant. What is the implication of a constant sales price? That means we do not have a downward sloping demand curve, or in economic terms, we would have a demand function as like we would see in a competitive environment, a perfectly competitive environment. What is the implication of having a variable cost per unit that doesn't change? Well, my variable cost per unit is a function of two variables. One, the input price for that resource, and two, the productivity related to that resource. If I assume that my variable cost per unit doesn't change, then I'm assuming also that there is no changes, or there are no changes in productivity. For example, we have learning curve effects, experience curve effects, diminishing returns, various different things that cause productivity to fluctuate. In the case of a learning curve, the more we repeat a given task, the better we get at it, so our productivity goes up. And what happens to the variable cost associated with that activity? It goes down. By assuming that our variable cost per unit is constant, we are ignoring any of these changes in productivity. Okay, we would also assume that we can readily break costs into both fixed and variable. We're assuming that if we have multiple products that our product mix is constant, and we're also assuming that inventory levels do not change. But what is the implication of assuming that inventory levels do not change? If my inventory levels don't change, then that means that my sales volume and my production volume are the same. So in our model right here, we have, as we said earlier, sales is driven by sales volume, variable costs are driven by production volume, but sales volume and production volume are the same. Okay, so I said we want to view this within the larger context of a decision-making scenario, and what that means is, as I've argued in previous problems, I don't want to look over here at the different type of questions they're asking me. I want to look at a given situation and try to understand it as fully and comprehensively as I can. So I'm going to recognize what the situation is about. In this particular case, it has to do with cost volume profit analysis, and then I'm going to go look for data. And with that data, I'm going to seek to create as much information as I possibly can to help me understand what's going on. Okay, what is the what are the data points in a scenario like this? Number one, sales price, variable cost, fixed cost, and possibly an actual level of output. Anytime I'm in a situation where I can find a sales price, a variable cost, and a fixed cost, then I know that I can employ break-even analysis, and I can create a lot of the subsequent type of information that we're going to talk about. What is the type of information that we can create with those three data points: sales price, variable cost, and fixed cost? Well, we can calculate our contribution margin per unit. We can calculate our contribution margin ratio. We can calculate our break-even point in units, and we can calculate our break-even point in dollars. If we have a fourth data point, an actual level of output, we can also calculate our margin of safety, and there's various different ways we can express that: margin of safety in units, margin of safety in dollars. Those are both absolute concepts. We can also express those relatively, such as absolute or margin of safety in units expressed as a function of our break-even point, for example. And we can also calculate or create information about our operating leverage. Operating leverage has to do with the cost structure of our organization. The cost structure is the relationship between fixed cost and variable cost. And colloquially, what do we mean by operating leverage? The more that fixed costs comprise of my overall total cost, the greater the degree of operating leverage I have. Just like financial leverage, which is a function of my capital structure, how I finance my assets, whether I use debt and equity, the more leverage I have in the system, the more sensitive my net income is going to be to changes in output. Okay, so I go into the problem looking for my data points, which is sales price, variable cost, and fixed cost. I have those right up here. There is no actual level of output in the problem at this point. Once I have those three data points, I can first calculate my contribution margin per unit, which is the excess of my sales price over my variable cost. How would we interpret contribution margin per unit? It is the amount of contribution that I'm going to receive for every unit I sell. My contribution margin per unit in this case is $32 per unit. I can also, and that's an absolute number, I can also calculate my contribution margin ratio. My contribution margin ratio is my contribution margin per unit expressed as a function of my sales price. How do I interpret my contribution margin ratio? It tells me how much of any given level of sales I get to keep in the form of contribution margin. In other words, if I have $1 worth of sales, I will get to keep 20 cents of that as the contribution on that dollar of sales. So the first two pieces of information that I'm always going to calculate are going to be my contribution margin per unit and my contribution margin ratio. And of course, I want to make sure I understand how to interpret those. Once I've done that, I can calculate my break-even in units. My break-even in units is going to be the amount of total contribution I want to generate divided by my contribution margin per unit. In the case of break-even is defined at that point where total revenues are equal to total costs. It's also defined at that point at which total contribution is equal to 0. In this particular case, the total amount of contribution I need to generate in order to break even is the amount of my fixed cost, $320,000. Each unit I sell will generate a contribution of $32 per unit, and therefore I need to sell 10,000 units in order to break even. My break-even point in units would be plotted here along my horizontal axis at this point. I can also calculate my break-even in sales. There's two ways I can do this. One, I can take my break-even point in units and multiply it by my sales price. Here on the graph, my break-even in sales is this point right here. The other way I can calculate my break-even in sales is to take the total amount of contribution I need to generate, again, my fixed cost, which is $320,000, and divide it by my contribution margin ratio. In either case, that's going to give me a break-even in sales of $1.6 million. Now, the best way to think about my break-even point is one from a risk perspective. In other words, I don't start making money until I break even. At that point, I start to generate positive contribution. So if you were looking at a given break-even point, 10,000 units in this case, and asked whether that's good or bad, you can't really answer that without knowing what your expected level of sales is going to be, which leads us into the next piece of information that we would want to generate if we have a given level of output or an expected level of output. Okay, let's assume that our expected level of sales is 12,000 units. If we have that fourth piece of data, we can also calculate information regarding our margin of safety. So to calculate our margin of safety in units, that's going to be the excess of our expected or actual level of output over our break-even in units. In this case, it's 12,000. We can also calculate margin of safety expressed in terms of sales. That is going to be the excess of our total sales at our expected level of output over our break-even sales. So our margin of safety in units is this distance right here, and our margin of safety in sales is this distance right here. We can also, those are absolute numbers, and as such, they're more limited. In other words, if I said my margin of safety is 2,000 units, I can't really tell whether that's good or bad because I don't have any idea of what the scale of my volume is. So I may want to express my margin of safety relatively as opposed to in an absolute form. So here I can express my margin of safety in units as a percentage of my break-even volume. In other words, my margin of safety in units is 2,000 units. My break-even is 10,000 units. So my margin of safety in units expressed as a percentage of my break-even in units is 20%. Here I don't need to know what my actual scale is because what this is telling me is I have a buffer. I have an expected buffer, an expected margin of safety that's 20% of what my break-even point is. Likewise, I could calculate this not based on units, but based on sales dollars in the same way. Another way to do it relatively would be to change the how I'm calculating that percentage. In other words, if I wanted to calculate my margin of safety in units, I could either calculate it based on my break-even point in units right here, or on my expected level of sales, this point right here. That's what we're doing in this calculation right here. I'm expressing my margin of safety in units as a percentage of my expected level of sales. So be careful when you're talking about margin of safety, and just realize there are a couple different ways of expressing it in terms of units, in terms of sales dollars, in absolute terms, and in relative terms. The next important piece of information I can calculate if I have that fourth data point, an expected level of sales, would be to calculate my operating leverage at that level of sales. My operating leverage reflects the extent to which I utilize fixed cost in my overall cost structure. And the higher my operating leverage, the more sensitive net income is going to be to a change in volume. So specifically, the way in which I would calculate my operating leverage, and remember, operating leverage is calculated at a given point. In this particular example right here, we would be calculating our operating leverage at an expected level of sales of 12,000 units. The way that I calculate that is to divide my contribution at that level of output by my net income at that level of output. So here's a calculation of what my contribution would be at that level of output, subtract my fixed costs, that gives me my net income, and I see that I have an operating leverage factor of 6 at that level of output. Now, how do I interpret that? If I calculate my operating leverage factor, what that allows me to do is answer the question of, assume that I have a given percentage change in sales, what will be the impact on net income? So if my operating leverage factor is 6, and I say, okay, I expect sales to go up by 10%, then I can calculate that I can expect my net income to go up by 60%. In other words, the 10% increase in sales times my operating leverage factor. Now I want to point out, you can always answer any one of these type of questions, just working it out in a long form by creating basically an income statement. But these are useful pieces of information that can help you answer questions in a far more efficient manner. So here's a question. Let's assume my expected level of sales is 11,000 units. Would my operating leverage be the same? My operating leverage factor be the same? Or would it be higher, or would it be lower? A question like this forces us to really think hard about what operating leverage is. And we can look over here at the graph. And what we can see is as we move along our horizontal axis in this direction towards zero, what happens to my different costs? Well, my overall total costs go down. My variable costs go down, but what happens to my fixed cost? My fixed costs do not go down because they're fixed. So as my actual or expected level of sales goes in this direction towards zero, what's going to happen to my operating leverage? It's going to go up. Why? Because my fixed cost as a percentage of my overall total cost is going to increase. Okay, let's summarize what we've done so far. We look at this scenario here and we see that we have three different data points: sales price, variable cost per unit, and fixed cost per unit. And anytime we have those three data points, we can start to calculate additional information, which helps us to, which enables us and helps us to understand the situation better. That additional information is first, contribution margin per unit, contribution margin ratio, break-even point in units, break-even point in dollars. If I have a fourth data point, fourth piece of data, expected level of sales or actual level of sales, I can calculate some additional information. Specifically, I can calculate margin of safety. That margin of safety can be expressed in multiple ways. It can be expressed in terms of units. It can be expressed in terms of dollars. It can be expressed in absolute terms or in relative terms. I can also calculate my operating leverage factor. My operating leverage factor, in this particular example, it was 6, tells me how sensitive my net income is going to be to a given level change in sales. Okay, now let's take a look at some of the things that they ask us. What's the annual break-even point in units and revenues? Well, we already calculated that. If 8,000 units are sold, what will be the share's operating income or loss? Now, as I said before, I can always do this the long way and just work out an income statement. But if I know what my break-even point is, it's 10,000 units in this case, and I know that every unit I sell has a contribution margin of $32, then I can very quickly calculate what my net income would be or net loss would be for a given level of sales. So for example, if we sell 8,000 units, we are 2,000 units shy of breaking even. Each one of those units has a contribution of $32, so we would have a net loss of $64,000. Let's assume that my expected level of sales was 12,000 units. What would be my net income? Or my actual level of sales was 12,000 units. What would be my net income? Well, 12,000 units is 2,000 units in excess of my break-even point, and each unit sold generates a contribution of $32, so that would be a positive net income of $64. What would be my net income if my expected or actual level of sales is 10,000 units? Well, it would be 0 because that's my break-even point. So the best way to understand this is to make an example as simple as possible. Let's assume that my actual level of sales is 10,001 units. What's my net income? $32. 10,002 units. What's my net income? $64. Let's assume my actual level of sales is 9,999 units. What's my net income? Minus $32. $9,998. What's my net income? Minus $64. You get the idea? Okay. Some of the primary uses of break-even analysis or cost volume profit analysis is to determine what level of output we need to have if we're going to launch a new product or start a new business, for example. Or in the case of an existing business, we may want to contemplate changes which is going to affect our cost structure. And we can use our cost volume profit analysis to get a handle on what that impact would be. So that's what question number 3 here and 4 are addressing. So in question number 3, management has decided to discontinue sales commissions, which are a variable cost, and increase salaries by a total of $90,000. In other words, they're changing our cost structure. Is that change in cost structure increasing or decreasing our operating leverage? Well, it would be increasing our operating leverage because our fixed costs, our cost structure is going to be one where fixed costs have a larger percentage than in the previous scenario. So if we look over here, here's our original costing information and our original break-even in units and break-even in dollars. And given the changes over here, under the alternative, our sales price is unaffected, our variable cost decreases from $128 to $120. Consequently, our contribution margin increases from $32 to $40. Our contribution margin ratio increases from 20% to 25%. Fixed costs increase by $90,000. And what happens to our break-even point? It increases to $10,250 and break-even in sales $1,640. Now, is this good or bad? Well, we can't answer that question. I mean, our break-even point has gone up, but the real question is that a problem? Because when I think about my break-even point, what I really want to be thinking about is, what is my probability of not breaking even? In order to answer that, I need to get some kind of handle on what my expected level of sales are. So if my expected level of sales were, let's say, 11,000 units, and I was contemplating this change in my cost structure, then yes, that might be a pretty risky thing to do because this is going to increase my break-even point, and I've got very, very little margin of safety. On the other hand, if my expected level of sales is 20,000 units, the fact that my break-even has gone up a little bit is of no problem because my probability of not breaking even is already extremely low. One thing you should always do in these problems or any type of problem is you should work out logically what you expect to happen before you actually put pen to paper and try to calculate. In other words, if I have an increase in my sales price and everything else remains constant, what's going to happen to my contribution margin, my contribution margin ratio? They're going to increase. What's going to happen to my break-even point expressed as units or dollars? It's going to decrease. What happens if my variable cost per unit increases and nothing else changes? Well, that's going to have a negative impact on my contribution margin, and that's going to end up having a negative impact on my break-even point. In other words, it's going to go up. What happens if my sales price goes up and my variable costs go down? Well, I've got a change in two variables, but they're not contradicting each other. In other words, the increase in sales price has a positive impact on contribution margin and break-even, and the decrease in variable cost likewise has a positive impact on contribution margin and break-even. What would happen if I had an increase in sales and an increase in variable cost? Now I cannot a priori determine what's going to happen when the dust settles because I've got one factor, the increase in sales price, which has a positive impact on contribution margin and break-even, but I've got the other factor, an increase in my variable cost, which has a negative impact on contribution margin and break-even. So again, to the extent that you can always try to reason out what your answer is going to be, and then when you actually calculate something, that calculation should be a confirmation of what you've already logically kind of worked out in your head. Okay, let's take a look at the next question here. Number 5, refer to the original data. If in addition to the original salary, the sales manager is paid a commission of 75 cents per unit in excess of the break-even point, what would be the operating income if 1,500 units were sold? So we're right back here to the original data, and my break-even point would be 10,000 units. However, once I hit break-even, what's going to happen? My variable cost is going to increase by 75 cents, so my contribution margin is going to decrease by 75 cents. So for every unit I sell in excess of my break-even point, I'm going to generate a contribution of $31.25. So the answer to this question right here would be 5,000 units times $31.25. This next question here introduces another thing we should always be thinking about, and that is a very, very powerful concept, and it's the idea of an indifference point. Anytime I have competing alternatives, it's highly efficient to calculate an indifference point. In other words, that point at which I am indifferent between the two different alternatives, and rather than having to recalculate under various different scenarios. If I calculate that indifference point, then I know that, okay, if the volume is above the indifference point, then I'm going to do option A, and if it's below, I'm going to do option B, or vice versa. How do you calculate an indifference point? Well, you set the two equations equal to each other. So if we're looking for the indifference point between these two different alternatives here, we're asking ourselves, at what level of output will my net income between this costing scenario or cost structure scenario and this cost structure scenario be equal? And when we work that out, that turns out to be 11,250. So if we were going to calculate what net income was at that level of output under these two different options, that net income would be exactly the same. Okay, so we know that we're indifferent between our two different options at 11,250 units. Which option would we prefer if we expect our volume to be above 11,250 units? Well, to answer that, we've got to consider two things. One, our break-even point, because if we haven't reached our break-even point, then we haven't recovered our fixed cost. As you can see, however, in this case, our indifference point is greater than our break-even points. So we don't really have to concern ourselves with that. And then the other thing that we would look at is, what's my contribution margin per unit? My contribution margin per unit under my alternative here, where I have where I utilize more operating leverage, is $8 higher. So here's the way to think about it. I sell 1,251 units. I sell 1 unit in excess of that indifference point. What's going to be my differential net income? Well, my differential net income is going to be $8 higher under the alternative method than under the original method. Okay, so if we come over here and we say so we now know that this cost structure dominates this cost structure above that indifference point, and vice versa. Below this indifference point, this cost structure would dominate this cost structure. So at 15,000 units, let's go ahead and calculate what our relative net incomes would be under the two different cost structures. Here's my total contribution at 15,000 units, fixed cost, net income of $160,000. Over here, total contribution $600,000, fixed cost $410,000. That gives me a net income of $190,000. This is $30,000 higher than this option. We already knew a priori that this was going to dominate that. So how can we go back and just verify this? Well, if we look at the number of units in excess, the number of units we have here, in excess of our indifference point, that's 3,750. And if we look at the incremental contribution margin of this alternative over that alternative, it's $8. So my 3,750 units in excess of my indifference point times my incremental contribution per unit gives me $30,000. Okay, next question. As the owner, which plan would you choose if we expected sales to be 12,000 units? Well, because we've calculated our indifference point, we already know that we're always going to opt for this cost structure if we expect sales to be greater than our indifference point. Suppose the target operating income is 180,000. How many units must be sold to reach the target operating income under the two different alternatives? Well, if we want to calculate target income, probably the most straightforward way to think about that is, how many units do we need to sell in excess of our break-even point in order to generate that net income? So under this option here, our original option here, every unit we sell generates a contribution of $32. So if we need to generate net income of $180,000 and each unit we sell generates $32 in contribution, then how many units would we have to sell? Right, we want to generate net income in excess of break-even, $180,000. Each unit contributes $32, so we need to sell 5,625 incremental units, or have total sales of 15,625 units under our original option. Okay, under our alternative option, we already know a priori that we'll have to sell less incremental units. Why? Because our contribution margin per unit is higher. In fact, we only need to sell an incremental 4,500 units. So the total number of units that we would have to sell under this option would be our break-even of 10,250 plus an incremental 4,500, so that would be 14,750. Now, is there another way that we could have logically come to that conclusion? Well, we know that this alternative is superior to this alternative at a volume in excess of our indifference point. If we're talking about generating some level of profit here, that requires volume to be above that, which it would, then we know it's going to take less units under this option than it's going to take under this option. In other words, at our higher level of volume, what are we talking about here? We were talking about volume of 10,000 units, 15,000. So this is consistent with what we already understand that's going on. In other words, in order to generate a given level of profit, we're going to get to that level of profit quicker if we're talking about volumes that are in excess of this with this cost structure right here. Okay, let's take a look at our last question over here. Suppose that you open the store on January 1st of 2013 with the original cost structure in place. Because you expect the cost of your product to rise during the year, you place a bulk order for 20,000 units and you lock in that purchase price of $120 per unit. But towards the end of the year, it turns out that you're only able to sell 18,000 of your product at your normal price, and consequently, for the remainder of your inventory, you need to mark it down to a sales price of $100 per unit in order to sell it. Finally, all these units are sold. As usual, salespeople get their commission of 5%. What is the annual operating income for the store? Now, before we actually look into that, you might have a question of why would we drop the sales price down to $100 per unit when it cost us $120 to buy the shoes? This is exactly the type of thing that we'll be looking at shortly when we get into the decision making. But the point here is that $120,000 is irrelevant for the decision of what to do with these 2,000 units because that is a sunk cost. In other words, it's not going to change between our alternatives. Anyway, there's two ways to solve this problem. One would be just to create an income statement here as we've done up here. So we have our 18,000 good shoes sold at $160 each. That generates $2.88 million of sales. The 2,000 units, the sales on that at $100 per shoe generates total sales of $200,000. That gives us total sales of $3.08 million. Our cost of goods sold, we bought 20,000 shoes at $120. Our sales commission is 5% of the sales price. So be careful here. Our sales price has been changing. So that 5% is that number right there is 5% of our total sales. Total sales, total variable cost, total contribution, subtract out our fixed cost, we have a net income of $206,000. Okay. The other way we could have done it is we take our $18,000 and we calculate the contribution on those $18,000. In other words, we're focusing on our contribution margin per unit, which is $32 per unit for good shoe. 18,000 good shoes, that gave us a total contribution of $576,000. We have 2,000 shoes, which has a negative contribution margin of $25. How did we arrive at that? That would be $100 sales price minus the $120 to purchase the shoe minus the sales commission of 5% of the sales price, which would be an additional $5. That gives us a negative contribution margin of $25 per shoe times the 2,000 shoes gives us a negative contribution of $50,000. Total contribution right here, subtract out our fixed costs, and we arrive at the same calculation of net income. Now, which of these two methods would be better? I'd argue that the second method is better. And the reason is because this highlights the cost I incurred in terms of negative contribution of misforecasting my demand for shoes. In other words, imagine you had some black box or some kind of service where you could perfectly forecast the future. If you were able to perfectly forecast the future, how many shoes would you have bought? You would have bought 18,000 shoes, in which case your total contribution would have been that amount right there, and you would have never incurred that negative contribution. So this information right here tends to be buried up here. So I would prefer this format right now. And finally, we have another alternative, and that could have been to simply take our chances and buy the shoes as we needed them. So, given that we've already introduced the idea of an indifference point, we can calculate the indifference point between these two different alternatives. Again, what are my two different alternatives? One is to do what we did, estimate what our demand for shoes is going to be, buy 20,000 shoes, and end up having to deeply discount 2,000 of them and end up with $206,000 in net income. The other would be to take our chances and buy the shoes as we deemed that we needed them, in which case the total amount of shoes that we would end up buying would only be 18,000 shoes. So how do we set this up? We set up the two options equal to each other. Well, this option right here is encapsulated in that number right there. So the option of purchasing the 20,000 shoes is right here. That has a value of $206,000. What we're solving here is for a shoe price. So if I take my sales price, for my normal sales price of $160, minus my unknown cost for the shoes, multiply it by the 18,000 shoes that I would actually buy, because that's what my actual demand was, and then also calculate what my sales commission was going to be, and then subtract out my fixed cost, and I solve for X. X comes up to be $122.78. So what does that mean? That means that if I think that the price of shoes are not going to rise any higher than $122.78, what should I do? I should take my chances. If I believe that prices are going to rise above $122.78, then I should go ahead and lock in the price and buy the number of shoes that I'm forecasting that I'm going to need. Okay, additionally, we can get a feel for that $122.78 by expressing it as a percentage of our existing purchase price for shoes, which is $120. In other words, $122.78 is 2.32% higher than our current price of $120. So now we would ask ourselves, if we think prices are going to rise no more than 2.32%, then what should we do? We should take our chances and buy the shoes as we need them. If we believe that prices are going to rise more than 2.32%, then we should go ahead and lock in our price, essentially hedge, lock in our price, and in order to lock in our price, we've got to forecast our demand. Okay, that's it.